The Greek philosopher Heraclitus has said that the only constant in life is change. This is true in every aspect of life, and it's no different when it comes to the stock market, where price fluctuations are to be expected. The movement of an asset's price over time is called price action, which forms the basis for all technical analyses of a stock, commodity and other assets. However, before you delve further into the study of price action, you must first understand the two important players behind it. Welcome to dooacademy. Today, we'll learn more about the dynamic duo behind price action, which is supply and demand. Supply and demand play a crucial role in the market and serve as the foundation of price action, where changes in one side directly affects the other. In simpler terms, the price and quantity of goods and services in the market are influenced by changes in supply and demand. For instance, when shopping for fresh produce, you may notice slight changes in price on different days, due to the weather and other factors that may affect production, which results in price fluctuations. Now, when there is a supply shortage and high demand, there will be an opposite reaction where price will rise. Similarly, if there is an oversupply and low demand, the price will decrease. This delicate dance between supply and demand not only affects the agricultural sector, but in all goods and services, including the stock market, as well as commodities and raw materials. Stock prices also dance to the tune of supply and demand in the market. When a particular stock is in high demand, but the supply is limited, you can bet your bottom dollar that the stock's price will rise. On the flip side, if a company has poor performance and prospects, with little interest from investors, this reduces its demand, and the stock price is likely to take a nosedive. Supply and demand also play a major role in foreign currency exchange rates or Forex. Forex is one of the most widely used financial instruments, which involves the currency exchange rates between two countries. Let's take the currency pair of euro to US dollar as an example. The first currency that appears in the pair, EUR, stands for the euro and is called the base currency. The second currency, USD, stands for the US dollar and is called the quote currency. Currency pairs indicate how much of the quote currency is needed to buy 1 unit of the base currency. For instance, euro to US dollar equals 1.55 indicates that 1 euro is equal to 1.55 US dollars. So, to purchase 1 euro, a buyer must pay 1.55 US dollars. If a seller wants to sell 1 euro, he will get 1.55 US dollars for it. Now, let's look at how supply and demand changes influence fluctuations in Forex. A country's economic data and monetary policies are vital factors that determine currency prices. If a country's economy is underperforming, the demand for its currency may be reduced, causing its exchange rate to drop. For example, if the United Kingdom produces dismal economic data, traders might decide to sell the pound, which increases the currency supply and decreases its value. In addition, a country's interest rates and trade performance also affect Forex. If a country's imports outweigh its exports, there will be a trade deficit. This in turn decreases the demand for its currency. It's important that investors and entrepreneurs understand the mechanics behind supply and demand to make informed investment decisions and avoid stepping on unexpected landmines while trying to earn profits. From stocks to commodities to Forex, let's move on to how supply and demand can also affect long and short trading positions. Traders and investors are often referred to holding long positions or short positions. Those who take a long position are betting on an asset's price to rise over time. When the demand for a particular asset rises, or if the asset supply decreases while demand remains constant or increases, the price will be on an upward trajectory. This makes long positions of buying now and selling later profitable for those who bought it earlier, as they can sell the asset later at a higher value. Short positions involve traders betting on an asset's price to fall. If the supply of an asset surges or if there is an oversupply when demand dwindles, sellers may be willing to accept lower prices to offload their holdings. Traders holding short positions of selling first when the price is on the rise, and buying later when the price decreases can profit from the difference when they buy the stock at a lower price. In both long and short positions, understanding supply and demand is crucial for traders to time their entries and exits. Market sentiment can shift rapidly, so keeping an eye on these factors helps traders make informed decisions and seize opportunities accordingly to the tune of supply and demand. Those who know how to play the long and short game are like champion ballroom dancers. As they tango with the bull and quick step with the bear, they gracefully maneuver their steps according to the market changes, which brings us to the last component: supply and demand. Here's a short poem to introduce the bull and bear market. Beware, dear friends, of the bulls and the bears. In this ongoing tale, they clash and fight. One charges high, the other swipes low, causing prices to change, like day and night. Bulls in general use their horns to thrust their opponents upwards, which is why an upward price trend is called a bull market. Bears, on the other hand, tends to swipe their mighty paws downwards in an attack, earning them the name for a downward price trend. To profit in both bull and bear markets, traders need to fully understand market supply and demand and other factors such as going long and short, which we touched on earlier, to identify current trends and make more informed investment judgments. Tell us, dear friend, now that you better understand the market dynamics of supply and demand, how will it help you make more informed investment decisions? Share your thoughts in the comments below. Be sure to like, share, and follow dooacademy for more actionable investment insights.